Welcome back to the Roll Up High Roller community. As always, nothing on the Roll Up is to be construed as financial advice. We are just some educators in the DeFi space. Toss us a quick like, give us a share, a repost, send it to a friend who may want to watch this, and finally, give us a sub or a follow. It means the world to help support credibly neutral educational content in DeFi. We're here to educate, empower, and enrich you, and let's jump in.
Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
What's going on, guys? Welcome back to episode 114 of the DeFi by Design podcast. Welcome to the bull market. Chris might not believe it, or Mai actually likes to go by, but I'm telling you it's here. So fade him at all costs, or else he'll talk your ear off about math for an hour. But today we're going to dive deeper, and we're going to go into some of, I think, really the weeds about omni-chain lending. I mean, I think there's different types of lending that's happening. And I'd like to really dive into the weeds there, talk about what Curvance is doing. We're here with Rob, of course, but we're running low on time. So we're going to skip right over to Mai. Mai, you had a background being a quant, doing some on-chain, off-chain math work. How did that kind of lead you to coming to build in DeFi and Curvance?
Yeah, so my background historically is in, well, first, thanks for the intro. I love the 114. Holy shit, you guys have really been cranking these out. That's awesome. So love seeing the triple digits there. But yeah, my background before crypto was in traditional finance. So I worked at hedge funds building systematic trading algorithms or asset managers, building a lot of like machine learning models, general statistical models, stuff like that, working with a lot of like big trades, hundreds of millions of dollars or billions of dollars. And like, how do you effectively buy or sell those positions when, that thing might not have traded in the last 2 weeks or something. A lot of like very exotic, like fixed income debt and stuff like that. So during COVID, actually, I started looking. I always had an interest in crypto stuff because when I was in undergrad in engineering before I went into finance, I spent a lot of time in undergrad like messing around with like Bitcoin mining and stuff like that with some of my housemates. And, we didn't do anything massive there. We didn't make a ton of money or anything, but it was pretty interesting. And then I kind of signed off from the industry for number of years as I went through, into finance, and then graduated, did my master's, went into, TradFi and all that. And then during COVID, dove back in and found it pretty interesting because I saw a lot of, articles and literature about all the cool stuff people were building with like DeFi Summer and stuff like that. And it felt like it matured a lot and it was actually becoming something interesting. And to me, it's really like one of the two industries. It's like crypto and AI that are actually building like new interesting stuff instead of kind of business as usual, like minor improvements. So to me, like I want to build compelling, interesting, like stuff that actually changes an industry, people's lives, like the future. To me, that's a lot more compelling than like just trying to make like a lot of money or like climb the corporate ladder or whatever. So it's just been an industry that's really captivated me the last few years.
Very cool. Yeah, thanks for taking us through the background and kind of leading up to like what you guys are doing now with Curvance. You spoke about how you kind of like refound crypto and specifically like on-chain finance and DeFi during
COVID.
kind of pandemic and COVID. Like what was like the portal? Like what was the entrance point where you're like, all right, this is going to be the rabbit hole that I dive deeper into? Like what was that entrance point, and then how did you ultimately find Curvance?
Yeah, no, that's a great question. So for me, just the way I like learning about stuff is just to jump in with both feet. So I have a background, obviously very heavy in like statistics, programming, building stuff, right? Like a software engineer, mathematician background. And for me, it was like, okay, well, how do I, if I'm interested in this stuff, and I saw a lot of different stuff, like dexes are interesting, like AMMs and money markets, and people building like permissionless like options platforms. A lot of this stuff that like requires a ton of people to underwrite or to manage, and like traditional finance people are now programming with code, and to me that was interesting. So it's like a whole basket of stuff like that, like Chainlink, and like a lot of things like Yearn, and these kind of now are considered like the OGs, but at the time were really like at the top of their game in terms of like proliferation of their technology. So for me, it was like, okay, I want to learn Solidity. I'm going to just like go through like, looking at people's code, messing around on like YouTube, just writing stuff myself. And I just kind of spent like day and night when I wasn't working, learning and teaching myself a lot of Solidity. And then as I felt more comfortable, I offered to volunteer at a lot of different DAOs. A lot of those DAOs are now like defunct, but as with most like DeFi summer volunteer DAOs and stuff, but it was an opportunity for me to really jump in with both feet and learn and just get exposure. All that stuff I did for free, so it was really just like for the love of the game there. And through that, experience writing stuff, volunteering, writing stuff, I ended up doing a lot of solo auditing as well. And that's, also helped me refine my craft. And then, just helping people build like their own projects as like a dev for hire and things like that. It's just like, I don't want to say like a notch in the belt, but more and more experience that kind of compounds into something where just, I'm able to refine my skill set, start building my own contract formats, making really efficient stuff, building cool tech. And that really snowballed into around May of last year. And I was introduced through a mutual friend to my co-founder, and he had this idea for Curvance. It was the original form was like this third layer on top of Curve, Convex, and a few other platforms like Badger and Yearn. And that took, it took a lot of people's interest, but it was something that was difficult to build at the time just because there wasn't the technology, like in terms of quality oracles and all this stuff. So I came in, and obviously I have a more Web 2 experience background. So I was able to kind of clean house and actually start scoping out building Curvance. And it was one of those things where we went through this whole bear market. We were like trying to raise money at the time, and then you have like Luna collapse, then FTX, like everyone's like, everything's going to zero. So we kind of, made it through with like a shoestring budget and a dream, really. And over time, we've been able to see what's been successful in the industry and what's not. So I use the example of like the ship of Theseus, where you're basically replacing one plank over time, and by the end of the voyage, the whole ship's replaced. And it's like, is this even the same thing? And to me, that's kind of what Curvance is. It's really become like my baby over the last 18 months here. So it started as this like high level, kind of optimizer for a few different ecosystems, and now has really become its own like juggernaut of a DeFi primitive. Now it could basically handle like any DeFi yield stuff, any money market functionality, like, everything from AMM, LP tokens, perpetual exchange, AMM token, or perpetual exchange LP tokens, interest-bearing stable coins, LSDFi products, liquid restaking, like everything. Any ERC20 token, basically. Permissionless, and so on. So that took forever to build. We built pretty much all of our code from scratch, and we were able to, like I said, see what's been successful and what's not. So a lot of like the crises that people have gone through, like, keeping the DeFi protocols, alive and growing and trying to make them thrive, we've been able to look at that and like improve upon those models, as well as like, throw out what we, had in our original design that maybe wouldn't have worked as, well in the more mature market. And we're pretty happy where we've ended up. It's really become this like huge juggernaut, and something that I really didn't expect to get, so involved with. If you told me I'd be doing this like 3 years ago or something, I would not have believed you.
Sure.
Yeah. I'm curious, like starting from the concept of building a third layer on top of Curve and Convex. Like, could you describe the things that you interplay with them? Like, how would Curvance as this third layer? And I realize that it's changed quite a bit since
Sure.
that initial concept. But could you describe like that first use case as that
Yeah.
layer on top of convex, and then we can talk more about like how you generalized from there to incorporate like several other applications and different token standards.
Yeah, definitely. So, in that original form, when I came in, the vision was to basically be able to take like Curve LPs or like Yearn assets or Badger assets, and then basically deposit them into Curvance, and it would behave akin to like a typical money market, a la like a Aave or a Compound, or at that time when my co-founder originally came up with the idea was Cream, right? So now you're going really far back. So it would have essentially been like a basic money market for those assets, and then your rewards just pool like you were in that platform. It just essentially is the same experience, but with this like added utility of like the money market, collateralizing, borrowing against it, leveraging it. Kind of akin to like Gearbox at that time. Is the example I would use. But it was one of those things where
it's really funny. I don't mean to interject, but like we now have this entire like liquid staking narrative for ETH, for like ETH staked and validators, and there's still like all of this like locked up liquidity in LP tokens, like you're describing. Like you have that Curve LP token, you don't really have the mechanism to make that liquid. So by providing a money market where you can deposit this LP token, now you have the ability to kind of make it liquid, where someone can borrow against it and you can get liquidity, whereas otherwise it would have been locked. So I don't mean to interrupt, but I think that's
it's
phenomenon about unlocking liquidity.
Yeah, there's a few different angles that we've looked at it. Like one is definitely that like kind of unlocking as we describe it. It's like, hey, you can just collateralize anything now, right? Like we could very easily adapt our code to support like NFTs in probably like a week of development. Does that mean we're going to prioritize that on day one? Probably not. But we could do anything, theoretically. So it's one of those things where we could really offer like this whole new universe of opportunities for people and see what people really like. And then we could double down on that and build greater support and, like keep maturing that vertical. But yeah, it was one of those things where like, as I was building this, I was like, well, this is like a really expensive process. So we should make these things auto compound, right? So that you just have your assets natively auto compound. That's going to get you better yield. You're not going to have to pay, especially because when we were first looking at this, like gas was still really high, right? So it's like, okay, most people don't want to pay $100 to claim $70 in rewards. That would kind of suck. So I was like, okay, well, why don't we make this auto compounding? Well, now that it's auto compounding, everyone's assets are together. Well, now we can abstract that away. And then why don't we support Balancer stuff? Well, why don't we also support like Pendle stuff? Well, now we should start looking at other chains because now we could support all these like really performant like DEXs and, different implementations. Well, a perpetual exchange LP token is basically the same thing. So why don't we support those too? And then you keep, going down that avenue. It's like, well, we could just support anything, right? Like we could support the most basic assets of like Wrap Bitcoin or Link or Uni or Maker or whatever you want, but also like these very structured, products like where you're talking about like Ondo finances, like treasury bills or, like all these different like almost like index fund tokens like GLP and stuff like that. We could support pretty much anything because of the vault design. And we try to take that vision with everything. That was like the first major breakthrough for us was like, let's just support everything. And then the second was kind of pulling apart the current view of Omnichain where it's like, I have tech that it, can function on one chain. And then I'm going to make my token Omnichain and I can call it Omnichain, like the whole protocol now. That's not really, in my eyes, like what I would call Omnichain. Like, so one, that's kind of like a captured term. So I've been using this term that I call like cross-chain equivalence now. So it's like, well, yes, like if you want to move like the CV token back and forth from chain to chain, you could do that. If you want to, have assets on Arbitrum and then get them on Optimism, you could borrow them on Arb, and then it's going to send them right over in that same transaction. So you get your assets on another chain. Well, if we have like gauge voting via like voting escrow models, well, why don't you let people vote from one chain to another or for any chain? Same thing with like fees. Rather than having people lock tokens on one chain and they get the fees on that one chain, why don't we aggregate them all together? And then now you could get fees on every chain, which is pretty cool for, a lot of these emerging chains. And it's been something that a lot of these different chains that we've talked to have been super excited about. So you just keep like abstracting away a lot of the, rough edges in what we see in DeFi today. And I think it helps, break down the barriers of like integrating and using DeFi products, right? Like you think about the average person that just bought like ETH on Coinbase and then they move it over to their MetaMask and they're like, okay, what do I do now? You have people that in the last cycle would look at YouTube videos for like LPing on SushiSwap, or maybe they're reading a Medium article for how to provide liquidity on GMX, or maybe even there's like long Twitter threads. Like you guys even, do some content on this. It's like, here's how you can, do these different strategies, or here's this cool tech you could use. What if we could like abstract away a lot of that and make it so like maybe your grandma can't do it just yet, but, any kind of normal DeFi curious person can. So suddenly you don't need to go on Twitter and figure out where the best DEXs are on that chain or how to bridge over to Base or, do all these different things. If we just handle all that complexity for you, I think it ends up just being a lot more enjoyable, because who wants to open 10 tabs to do some complex operation when you could just open one and use Curvance?
Yeah, a couple of things. On the last point, the all-in-one model is definitely becoming more popular. They just put swaps on their platform. I know other lending markets have integrated DEXs and bridges all into their platform, which is like a huge thing, because again, like going to 4 different apps to bridge, swap, deposit, lend, borrow, swap, rebridge, utilize some other app is just a lot.
A tongue twister.
Yeah.
Let alone doing it.
Right. And then on the omni-chain concept, I think you're totally right. The projects that we have right now that are like cross-chain, omni-chain are like close, but they're not like that true definition. And so Catalyst is an AMM that's coming out that's going to be like fully cross-chain just by design with their code. You guys will come out as well, and then we'll see your implementation either with Wormhole or some other kind of technology like Axelar or one of these to enable that. And yeah, that kind of deposit on one chain, borrow on the next, all in one transaction, get used liquidity across different chains to get the best rates on DEXs, things like that. Feels like we're like getting really close to that. I think that's going to be a 2024 thing. And that's something that in 2020 we were kind of like dreaming of. And then we had like Aave go to Polygon, and we thought that was the coolest thing ever, that we could bridge to Polygon and still use Aave. And now it's like we're going to use all these different chains in this way that you described. And then the final thing is you brought up Gearbox, which Gearbox has recently put out a really cool V3 credit account abstraction model. And I'm curious from your perspective on the protocol side, what you think about the dilemma where we have basically there's like 2 or 3 dilemmas. One is, how do you ensure users don't get liquidated? Basically, how do you ensure that users come back and pay off debt? And how do you ensure that users don't take their funds that they borrowed from your app and go use them in some absolute degen pool, thus, without your lenders knowing? And then obviously, they get wrecked, right? That's what happens. I go on Aave or I go on XYZ, I borrow, I go ape it into some meme coin. It goes to 0. All of a sudden, I've got this borrow on Aave. I just walk away. Obviously, I borrowed less than what I had in collateral, but if my collateral also goes down, obviously there's liquidations and things. But what I was getting to was Gearbox is doing basically, they're implementing basically a smart contract wallet with a allow list of dApps that their borrowers can go and use. So there's like an allow list of smart contracts. So if you borrow some stables against your ETH, you're only allowed to go to these X, Y, and Z highly trusted, secure dApps. And then there's also a mechanism wherein you can code the wallet, but it's the repayment is guaranteed over some time or some sort of mechanism. So yeah, I'm curious like how you plan to tackle those two main problems, and then if account abstraction in that sense, like Gearbox is doing, could be a solution or is something that you're thinking about. Yeah.
Yeah. So first off, I do love that the Gearbox guys are still grinding. They're like one of the OGs. So I love to see people keep at it and, keep innovating. I think there's a lot of ways to skin a cat, as they would say, for that. For us, I'm not saying we aren't, looking at those types of models like account abstraction and stuff like that. But the way, as you talk through that, I kept thinking like, well, a lot of that is like handled around like, how do you offload risk, right? Because you have these lenders that basically are the counterparty against them. So if, like you said, if someone's just buying a meme coin that goes down to, 0 in like 4 seconds, it's kind of hard for them to pay back that loan, right? Or if they like get wrecked somehow, they click on the wrong link or, whatever, or, some scenario where they get wrecked. For me,
Just trying to protect that bad debt effectively.
Yeah, so there's 2 ways that we've approached that. I'll start first with liquidations and then the bad debt side. But on the liquidation side, we came up with this new, what we call like this dynamic liquidation engine. And what that does is typically money markets have this dilemma, as you highlighted. Either one, you want users to, you want people to use your, app and make sure that they don't like feel like they're getting scammed, right? Like getting liquidated really easily. But at the same time, you need to make sure that if volatility hits, like, Gary Gensler, arrests Vitalik or something, and ETH goes down 30% in a millisecond, like how do you not have the whole thing blow up, right? Because a lot of times there's no real offset for bad debt and these different, issues that could arise from like insane volatility. So for us, what we did is we built this like kind of dynamic system. So rather than typical money markets have like a liquidation level where if you hit that level, then it closes out some percent. Usually it's around 50%. Some really protective platforms do 100%. Or, maybe there's some other numbers in there too. I'm sure everyone has their own blend. For us, we built this kind of liquidation region that I call it. I'll call it a band, but it's different than the Curve USD band system, which is another good model out there. But for us, essentially, as you hit the top band, it does like a soft liquidation. So that's going to be a lower penalty, lower close factor, like smaller amount of assets closed out. But as you seep into the region, if you're not getting liquidated, maybe price is moving really quickly, or, MEV bots or users don't think that it's worthwhile to take on that debt. The penalty gets larger and the amount of the position that can be closed out increases until it hits the bottom, and then it can fully close you out. So what that does is like if someone is just, in like kind of basic assets with like normal risk parameters and, like there's not a ton of market volatility, maybe they tap that soft liquidation, but they're not going to feel like they got ripped off because it's like a small amount of collateral and the penalty wasn't too bad, right? But if there's really violent volatility, like when the fake ETF news hit, and then it went up a ton and then down a ton, like that person probably will get slammed much harder, but we don't take, like the lenders don't take on any bad debt from that. So it accomplishes like that kind of like kindness to the, borrowers, but also doesn't like slap the lenders with any major risk. The other side is if somehow bad debt does accumulate, maybe the move is like so violent and there's not enough on-chain liquidity, or like gas spikes to 10,000 or something and it's just not worth it for people. There's a way to socialize bad debt in Curvance. So one of the typical problems is like there's really no way to handle bad debt because no one's going to liquidate it and give you money for free. So a lot of times it just sits there. So then essentially it's a race for the exit, right? So if there's $1 million in bad debt, which would be a huge amount, but just for argument's sake, and there's $10 million in that pool, that means the last 10% of people that are getting out, they have nothing. Right. So there's this like game theory aspect. Well, now because there's bad debt, you don't want to be left holding the bag. So you're going to leave. But with this, essentially, it can be handled like a natural liquidation, and then it just offsets essentially the exchange rate on that token for lender. So it socializes it rather than the last 10% of people getting slammed with like 100% loss. In that like really bad case, it would offset the value of everyone's lent assets by 10% from that 10 million down to the 9 million. So now that should be much less frequent, if ever, on Curvance, but it's important to have those kind of escape valves for those like really dangerous like black swan events.
Yeah, we've seen those happen. Like anytime there's a lending market, like an issue, that it tends to be with some sort of like pricing. Normally, what we've seen is that it's due to some illiquid collateral, and what tends to happen is that if you're able to deposit some collateral that's illiquid, it's so easy to pump the price and like artificially like increase the value of the collateral that you have on the market. Means that you can borrow all of this liquid value and then go sell it off, and then whatever happens to the illiquid price happens. So I'm curious what the Oracle like solution for that is when it comes to LP tokens. Is it a matter of like looking at the contents of the LP tokens, like most easily understood is probably like an ETH Bitcoin pair on Uniswap. That ETH Bitcoin is, if it's a V3 pool, it's an NFT. That NFT doesn't have like a very liquid pool of liquidity that you can just sell off somewhere. So do you look at like the contents, which would be the ETH and the Bitcoin inside that LP, quote those, determine a value for the LP, and that's what you treat as collateral? And if so, like how, like what is the Oracle solution to kind of like do that calculation with low enough latency that you can still make liquidations?
Yeah, that's a good question. So a lot to unpack there. So I'll kind of break that question down a little bit. On the Oracle side, we built this pretty comprehensive Oracle system. I call it like a pessimistic Oracle. So what it does is we're able to take in prices from any different Oracle providers. So that's like, on-chain ones like Curve and Balancer and Uniswap and whatever. But we could also take in price feeds from like Chainlink and Redstone and all these other different providers. And we could basically aggregate any two that we want. And then it takes the better of the prices for the lenders in that case. So if it's valuing collateral in which someone, in your example, maybe it's like this USDC, or you said ETH, Bitcoin, LP, it would look at the value of those underlying assets from both of those feeds and then pick the lower one and then aggregate like, okay, well, the LP exchange rate is blah, blah, blah. And then it's going to take the lower price of that. And then maybe they're borrowing USDC. And I mean, generally USDC should be worth $1, but it isn't always, as we've seen. It would take the higher price on the lent asset side. So you're taking the lower price in terms of the valuation of that collateral, and then the higher price in terms of what that person owes. And that, while it's not a huge differential, it does help in like very volatile periods where there is like gaps in pricing between different, whether it be exchanges and on-chain or just, DEX to DEX. And it also has logic in there with what I call like the traditional finance equivalent would be like circuit breakers. So if someone is trying to like pump the price and manipulate the oracles, if the prices diverge too heavily, currently it's 10%, but this can be configured and maybe it's, closer in the final release. But if the prices were to move more than 10% away from one another, it pauses borrowing. So in cases like Mango's protocol, where you had highly profitable trading strategies, it basically locks down any borrowing from that, because not only do they need to, manipulate the price, they need to manipulate different DEXs or centralized exchanges. And then not only do they need to manipulate it in a more comprehensive manner, they also need to make sure that they're manipulating those sources in such a way that they don't diverge. So in a lot of our kind of internal analysis, it could take anywhere from 40 to 50 times as much like initial capital to manipulate prices. At that point, it's just not worthwhile, right? it's easier to go to like some other party and try to like attack them. The second piece there is on the collateral itself. So we look at on-chain liquidity. More specifically, we look at the offside of the liquidity. So, for example, I'll use the example of ETH. But say the majority, obviously ETH is very liquid. So maybe we pick like a less liquid token. Like recently, Curve, the CRV token had like that whole pool kind of disappear. So a lot of the liquidity was in like the CVX CRV pool and some other pools on Uniswap and such. So we can look at the offside where maybe you're looking at an asset like, CRV, but the pool is kind of slanted, especially for paired assets like with CVX CRV. So maybe the pool is like 80% on one side and 20% on another, or Balancer even has pools like that just naturally. You don't care that there's, say $10 million in liquidity if there's only 20% in something that you really want to get into, like a less illiquid token, a more liquid token. So then we would say, okay, well, there's 2 million in that like offside liquidity. And then we would take some percentage of that, say 30%. So it's like, okay, collateral would be capped out for that particular asset at $600,000. Now, of course, those numbers are very depressed, but in general, it shouldn't massively impact needs of people, because what we also do is we've moved to this like posting collateral model akin to what you'd see on like a perpetual exchange or a centralized exchange. And what that looks like is you could deposit an infinite amount of assets to like yield farm. Maybe you're farming like Curve LPs or like CVX CRV or something on Balancer or GMX or Pendle or whatever. You could farm an unlimited amount. We don't care. But if you want to collateralize that asset and borrow against it, there are collateral constraints. So when you're posting that collateral, we check at what the outstanding collateral for that particular asset in that particular market is. And that allows us to cap what the market exposure is to lenders. So you don't have that situation of someone just taking, $10 million of an asset or even $1 million and they manipulate it up to 10 million and then they deposit it, borrow a bunch of stable coins and, go on their merry way. It doesn't work. Another piece that we added to that is we added a 20-minute minimum to both collateralization and on loans. So a lot of like the kind of manipulations, I don't want to go onto Twitter and see like a Peck Shield tweet about us, like Curvance, you got to check out this contract. And I'm like, oh shit. But when people create these positions, there's a 20-minute minimum time frame. So any of those flash loans where people fund a wallet with like, $100 from Tornado Cash, and then they go to Aave and they borrow $50 million and then manipulate the price of this like super complicated, attack and then steal millions of dollars. That doesn't work at all on Curvance because the flash loan breaks because we won't let you take the assets back out in under 20 minutes, essentially. So it's actually pretty similar to what GMX's GLP does, the V1 where it has the 15-minute minimum. So we've kind of looked at all these different stages of like, how can we get bopped and then avoiding each of those scenarios.
Yeah, it must be nice to build 3 years after everybody gets bopped,
Yeah. Well, that's what's been a huge help to us with the bear market, because we keep seeing like the same, okay, these guys got hit with some reentrancy attack, or this was a price manipulation, or this was an empty market attack. And I'm not going to go into like all these individual scenarios, but you see the same ones popping up over and over and over again. And we've taken a lot of time to look at all of those issues and basically go down the list. Will we get screwed from this? Do we have like, is this possible in Curvance? How do we fix this? How do we avoid that? And so on.
Yeah. And before we kind of wrap up the next 5-10 minutes here, we'd like to talk about the strategy you guys had to kind of really onboard a lot of different DAOs and community members within DeFi, whether it be with your raise, which we can touch on, and just with your general partnership angles, and how you feel that's going to help you, what as you launch, and also kind of what that could look like in the next year or so. How you see Curvance integrating with all these teams that either invested in you or that you guys are currently in talks with to partner with, one way or another.
Sure. Yeah. So for us, it's been kind of like an everything approach with them. We don't want to just like be like, hey, we're going to support people's stuff and can you retweet us, right? Like that's a very shallow and sometimes those relationships are fine, right? But like a lot of our core, like strategic joint ventures or collaborations, whatever you want to call it, to us, those are ones that should be like an all of the above approach of like, we're doing co-marketing, obviously, but like you're also invested in our seed round and you're putting TVL like assets in. Maybe you're moving some of your protocol and liquidity. Maybe we're co-incentivizing stuff. Maybe you're reviewing our code, right? So who better to audit our code? And obviously we're going through a ton of audits, but who better to look at and review our technical solutions than the people that wrote that code themselves, right? The code that we're interacting with. Or like, different, things like maybe integrating them with our test net or different, events, right? Maybe it be like, maybe someone puts on like a trading competition, right? And people can LP through Curvance is this like, now they're building out liquidity too. Because we offer a lot of tools to these different projects. I mean, especially CDPs, like,
what are some of the ones in particular?
Yeah. So we've already got a lot of formal investments from, a lot of CDPs like Frax and, now Redacted is launching their Dinero and that's like a CDP. So, those are like two of our lead investors. We had a very unconventional route for our raise. We didn't like go heavy with VCs and stuff. We did get offers a little over a year ago to like just fill out like a big, juicy seed raise round, expand the round, sell more tokens. We could have gone that route, but we chose not to. We wanted to be much more strategic. So all of our major investors are like either the DAOs themselves or angels at that DAOs, at those different DAOs or protocols or whatever, or maybe like small LPs that would, participate in a larger round. So we've gotten like a lot of participation from like angels. Like I have my Scroll shirt on, Scroll participated, Polygon, Wormhole, a lot of different platforms that we're really excited about, whether it be chains, infrastructure, or the dApps that we would work with and kind of champion ourselves. So that's been like one really easy way to align with them is like, Confluence. It's like, we're not just building in their shadow, we're building alongside them, right? So we're helping them, expand, mature, and really get their feet under themselves so they can keep, pushing the envelope on whatever their goals are. So for us, that's been very strategic. And a lot of these teams we've been working with for like over a year now. So I would say a lot of the massive like CDP providers are pretty interesting to us. So they've been ones that we've been talking to a ton, as well as like perpetual exchanges like GMX and MUX. So those are the ones that we're predominantly focused on our launch, as well as some, I'll call them like trailblazers like Pendle that are building some pretty cool tech, but it's not really like they don't have a ton of competitors. So they're kind of off on their own island in a lot of ways. So supporting their stuff has been really cool. The Pendle guys have been great to us. And we also have an angel contributing to Pendle as well. So, hoping to help these guys, build out liquidity, improve the utility of their tokens, like being able to just engage in those ecosystems in a really easy way. And I hope that eventually people become confident enough in Curvance that they're like, if this is, call it blessed by Curvance and that we have confidence, like we've done our due diligence, we've vetted the team, the contracts, we've audited our code, we've looked at their code, made sure they have good audits, made sure the liquidity is good. Like you can have confidence in this thing. Like that's where we want it to be eventually. Not like, any advice. It's not financial advice, as they say, but, we're only trying to work with like the cream of the crop. We can support any asset, but we're choosing to support the ones that we think are the best.
And yes, sir, Rob.
We're friends with Pendle. The whole
friends with everybody, Rob.
Very popular.
Guys. Yeah, this was lots of fun, Chris. I mean, It's been an absolute pleasure, having you on and learning more about the generality of the tech, because ultimately, I love the strategic approach that you said, like the FU to VCs, like we're gonna go the route where.
All right, it wasn't that bad.
No, I mean, and I'm sure it was like a friendly FU, but it's like there's like more value that can be provided than a check. And by working together with the partners that live on chain, then you become closer and deeper partners with those, and it does go beyond the check. It goes to the co-marketing and the co-incentivizing and the reviews of the code base.
Yeah, or even just building tech together, right? Like we'll build on top of their tech, but there's also a lot of projects that we're talking to that want to like build stuff on top of Curvance. Does that pan out? I have no idea. But it's like much more, it's a lot easier when you're like joined at the hip in more ways than just like, well, we got to do something, so we should support your stuff. That sounds okay. It's like much more like we're excited about the future and you guys are too.
Yeah. And then you're building it together, which is like there's something at stake for both teams. And it's like, all right, you kind of like when both teams put, money where their mouth is, there's a common interest and a common goal. And I think we're all able to like go further together. So it's really cool to see you guys take that route. I know we're running up on time here. So the final question that we got, unless you got another minute to stick around, and
I can stick around. Yeah, that's fine.
Yeah, cool. Well, I do have another question, like a little bit more in the weeds. So before we kind of wrap up, my curiosity is in the yield, because like with regards to any money market, lenders are going to go where the best yields are. So for LP tokens, and like this question, I think we can get real creative, because we're all kind of degents here. So like there are strategies that come out, like when you can borrow LP tokens. I think this is part of the new primitive element that you guys are helping to unlock. So my first and foremost question is like, where does the yield come from? Does it come from token emissions, or does it primarily come from interest that borrowers pay? Yeah, we can start there, and then I'd love to get into the strategies of like borrowing LP tokens, cash and carry position. Like we can, yeah.
So on my end, it was much more like we don't want to just build like we just give you a ton of tokens and you do whatever, like that kind of like. I don't want to use the term Ponzi, but like the kind of like a mission-driven yield. We do have our own gauge system, and we've done a lot of innovation on that front. But I'll start on like the asset support side and yield before getting into that. So we can support like yield-bearing assets in full, i.e., LP tokens, like you highlighted, or these like interest-bearing stablecoins. But it doesn't have to be things that just give you emissions. So it could also just be like wrap stETH or like Ondo, USDY, or even just wrap Bitcoin and stuff, right? Like you're not going to get any native yield on wrap Bitcoin for it just sitting there, right? So we can also like deposit those assets, but there's always a trade-off, right? Like we could go to the highest and best like yield, but maybe it's a very like new and like kind of unstress tested platform, right? So it's like, to us, it's much more important that like you have confidence that like nothing's going to blow up, and that everything's going to, when you go to bed and you wake up, like your stuff is still going to be there. That's the most important thing, even beyond like just try to squeak out that last bit of yield. So we are going to be working with like the best, platforms to generate yield for these like underlying, LP tokens and, the different, like assets, like futures related stuff like Pendle and all that stuff. But there are also those more, as I call them, like primitive assets that they just sit there. So in some cases, it is an auto compounding like vault. It's like a step in for you having to claim it every few hours or, weeks and compounding it. But in other cases, it's more akin to like a basic money market, like a Aave or a Compound or something like that, where, yes, we could also deposit it under into Aave under the hood or something else and squeak out a bit more yield. But now what happens if utilization goes 100% on there, right? Now you can't get your stuff out. Well, that's not good. That's not a model that we want to build on top of. So in some cases, you could really pick what your risk profile is right. is like what is your risk tolerance, and then you can kind of like, do you want to go like kind of that more degen route, as you said, like LP tokens, or like like some of these more newer assets that are a bit more exotic, or do you want to just like, I'm just bullish on Bitcoin, so I'm gonna just wrap Bitcoin in here, and I'm gonna borrow USDC, and I'm gonna go buy a car, right? You could just do that too. Or you could like do a lot of these leverage strategies as well. Like we've built native leverage in, so you can like leverage up and leverage down in a single transaction like you would a perpetual. So because there's no open and close fees on this stuff, and you're paying interest on your loans, it actually in some cases, if liquidity is really deep and you're not worried about slippage and such, you could use it to almost like perp leverage some of these positions. The other thing that's really helped with that is we've removed what people call rehypothecation. So one of the biggest worries that a lot of people have with these like really risky assets or exotic assets like LP tokens and stuff is like, well, what happens if someone borrows it and then maybe they just try to like send that token to zero, right? You just borrow all the LP, you unwrap it, so now the LP is tiny, and you just nuke that token down to zero. Well, now, you just like, you've exploded your collateral there, so now your debt in that case, so now you've made a bunch of money, right? So you've kind of like drained that project. We've pulled all that out. So like if you're depositing an asset or you're collateralizing it, you cannot like have people borrow that asset. And if you're lending like a USDC or like ETH in an LSD market, then you're not going to be able to borrow against it unless you're depositing it on the collateral side. So it fixes a lot of those like tail risk pieces, and that allows us to like be much more aggressive on things like collateralization ratios, liquidation rates, what stuff we're supporting, how the markets are structured, because we could do isolated or cross. We basically could do anything, and we've pulled apart a lot of like the risk, the tail risk there, that makes us uniquely positioned to support a lot of really cool stuff with like a lot of really cool features.
Very cool. Yeah. Isolated market. Us. Go ahead, Andy.
I look forward to seeing it.
Yeah, I think it's going to be pretty cool for a lot of people to start messing around with this. We've spent a lot of time, even outside of all the contracts. We talked a lot about contracts, but the other piece that we've spent a ton of time on is like the user experience. So, I've obviously, in the last, since like COVID, I've been my own like DeFi degen, and really at the end of the day, I've built like the app that I would want to use myself. And we've taken a much more like Web 2 approach to the DApp, where it's like communicating a lot of information, a lot of quality of life in the app, so you can do stuff really easily. Like even just the leveraging piece, I'm sure you guys have used a money market. Maybe you want to like leverage up on something. You got to like deposit it. Then you got to borrow it. You got to go to a DEX and swap it. Then you got to deposit it back in. Then you got to borrow more. Like you're doing like 15, 16, 17 transactions.
No. Never did anything like that in my life. Why would we do that? but
you can do all that stuff super easily.
Yeah.
So it's like,
are you planning to have it on the site, like on the DApp, like all within it, like swap, bridge, buy, sell? Yeah.
Yeah, you can do everything basically. DApp. So if you're like, I want to go bridge to Arbitrum from, Optimism, like you could just use Curvance instead of like going to, like whatever bridge your choice, or maybe you don't even know the right bridge to, how do you get to base, right? Or how do you get to scroll, or, a lot of these platforms that are like, a bit newer people, the knowledge is not quite as like out there, right? So like we can kind of help with that. So, we've spent a lot of time looking at like the typical Web3 DApp, and, they serve their purpose, but I think a lot of UI UX is kind of broken in Web3, where it's like there's this huge burden of knowledge. Even when you're talking about like yield opportunities and stuff, one of the things, and this probably won't be in it when it's live, but it's something that we'll be working on like on the roadmap, is I want to get the basically information to people on like what opportunities are out there. So maybe you're in like a Steth ETH LP pair on like ETH and you're getting 4%, but like you could actually get 13% on Arbitrum in Camelot, or something, right? Well, wouldn't it be awesome if instead of you having to like go to Camelot and check out the rates and then go to, Base and check out Aerodrome and then go to Velodrome on Optimism and then you're going to like, all these different chains and dexes, like, oh, what's Curve on this chain? What's Balancer on this chain? Like it's a huge amount of work, right? So why don't we have behind the scenes something that just like does some analysis on it, says, okay, so based on the rates on DeFi Llama or whatever, you can get 13% by just moving over here. You don't have to change what asset you're in or anything. If you want, you could zap out of the position, bridge over and zap in. We'll queue up all 3 transactions or all 2 transactions and you're good to go.
It's very much a Web2 oriented philosophy to give recommendations to people. Like you scroll on pick your social media application, like 99% of that is all recommended content, and recommended transactions and strategies, I think, follows right along with that strategy, that mindset.
Yeah.
It's very cool to see that like brought to life.
Yeah, I think we got to be careful of like, the like recommendation, aspect to it for sure. But, I think if we could like just have it like easily discoverable for people where they can just like poke around and it's just like, hey, you have these opportunities out there. I think that's going to move the needle a lot for people because like instead of having like 10 tabs open, you could just have one, and then it's like it's your swapper, your bridge, and, like all your money market and yield farming. So it really becomes like this everything app for DeFi.
Cool. Any other key roadmap items that audience and people listening should be aware of to like just kind of like keep track of, whether it's Q1, Q2, TGE, any other roadmap items that you think people should be aware of?
Yeah, so we've really been turning on like the engine, if you will, in December for things like the seed round announcement and white paper and all that stuff. We're going to be running a test net starting hopefully towards the end of December, but if partner integrations take a little bit longer, it might bleed into January. And people will be able to try out like the full app. And then we're going to be moving towards like a beta release, either in February or March. And that's going to be basically live on Ethereum mainnet. There is like a minor incentivized airdrop for the testnet as well as participation in the beta. You get streamed call options in both. And we are exploring like a referral program in the beta release as well. After 4 weeks, we'll be moving into what we're calling like the official release. And that's going to be where it goes multi-chain onto, still on Ethereum, but also Arbitrum, Optimism, Base, and Polygon ZKVM. We are also looking at additional chains such as like Scroll, Mantle, and a lot of other parties like ZK Sync and stuff. It's unclear, when those rollouts for those different chains would be, but it's very much, again, we're very strategic. So we're in contact with these different teams and seeing, what that rollout would look like and what makes sense for everyone in terms of priorities and everything. But we do plan on having like a wave 2, wave 3 approach for different chains, different assets and everything. But the goal is really to, if you want to like borrow or lend, or you want to just yield farm, we probably support it. That's the end goal. And we do plan on having like an incentive market for like vote escrow on CVE. We have built some really cool tech around streaming incentives with different projects. So things like Arbitrum Stips have been really successful. So it's even easier to set up all that stuff on Curvance. So instead of you having to build out these models yourselves, like airdrops via Merkle trees or, building your own contracts to stream rewards, you could just set up all that stuff on Curvance without any code written, which is pretty, I think, compelling because people can create incentives on both the collateral side, but also the debt side. So maybe you're generating a ton of money on your yield farming strategy. Great. Like you might want to just get people to lend against you so that you can like lever up and do more of that strategy. Well, you could incentivize the other side. Or maybe you're in like a more long-term, stable position where you just want to get some additional yield on top. Well, you could vote for your own stuff or stream your own incentives on top for that pool. So a lot of really cool strategies in terms of how different incentives are provided to people. And we're also going to be, as a last piece here, we're also going to be open sourcing a lot of our tech around like the cross-chain sharing fees, cross-chain gauge voting, and like the Oracle system. We're aiming to open source a lot of that stuff. So I think it moves the needle a lot. We are spending a crap ton of money on audits. So for a lot of teams out there that maybe are looking for the next step or innovation or improvement for their own tech, it might be worthwhile to check out the Curvance innovations on that front.
Sweet. Very cool. And for anyone who is still listening and towards the end of this video, you're a legend for making it this far. Pretty deep in that last answer that Mai gave, there was the word airdrop. So I just want to make sure that's heard loud and clear. But yeah, Mai, you're a legend in your own right. So thank you so much for coming on. The last question, as I think we're about ready to wrap up here, is that we asked this to all of our podcast guests, all 113 that came before you. So if you were stuck in an elevator for however long, a minute, 2 minutes, if you had to talk to one person and give them, if you had a Curvance pill, one person, who would you choose and why?
That's an interesting question. Alive, dead, both?
Dead or alive? Anyone in your imagination you choose?
That's a good question. Yeah, I mean, if you're thinking about like people that I just want to talk to and be like, hey, this is really cool and I'm excited about it and you should be too, it'd probably be like some of the people that I respected and looked up to when I was younger, like the scientist Richard Feynman. But if you're talking about alive or just like someone that'd be cool to, hang out with and just talk to, probably like, I don't know, like Keanu Reeves or something. He seems like a cool dude. Someone outside the industry, right?
We've heard Vitalik, we've heard Satoshi, we've heard, the whole slide.
Oh, well, that's boring because they're gonna like, know their stuff.
It's so funny. It's like everyone tends to come up with like a new angle. It's great. I think Feynman and Keanu Reeves are both first.
Well, there you go. I could be the strange man that didn't offer a crypto person there. Yeah. But I feel like you gotta pick someone that's like, totally out of left field where they're like hearing this stuff for the first time. So one of them's dead and the other one is very much, to my understanding, not in the industry. So I think those are probably the most interesting ones that come to mind for me.
Yeah. Yeah. Well, great answers all around and a phenomenal podcast. Thank you so much.
Thanks for having me.